I'm Joe Mantone, an editor with S&P Global Market Intelligence and host of the Pipeline podcast, which examines all things deal making. On this episode, we'll hear from Wes Riggs, head of equity capital markets at Truist Securities, who will discuss IPO activity in 2024 and the outlook for 2025. Wes also touches on interest rate cuts and U.S. elections and how they will impact the market. Hi, Wes. Thanks for joining us today.
Good afternoon.
August is traditionally a slow month for IPOs. Is that what we've seen this year?
That's correct. This year we've seen no different. For August, we've actually had no IPOs of any size anyway during August. And by that, I mean anything greater than $100 million. The last IPOs we saw were several that happened back in July.
And are we expecting to see a pickup in September?
We are. We see IPOs again after an August slowdown. The first 2 weeks in August, we usually see some activity. But this year, due to the volatility in the markets that we saw in the beginning of August, we didn't see any IPOs. The second half of August is traditionally a very slow or no IPO timeframe. But post Labor Day, we typically see and we do expect there to be several IPOs to launch during September.
So just the market turbulence that sort of gave some companies pause about looking to go public?
That's right. When we saw some of the spike in volatility and some of the market dislocation in the beginning of the month, that gave investors and companies a little bit of pause and cause for concern. But we've come through that volatility and the markets have stabilized and the rate environment is improving and the outlook for the overall markets is actually quite good. So we expect the market to be vibrant come the fall.
So you don't think investor appetite has waned at all?
Not at all. If anything, I think investor appetite continues to improve, not at a brisk pace, but at a slow and measured pace. We've seen the performance of IPOs so far this year overall perform fairly well. And how I think about that is when you look at the S&P and the NASDAQ, year-to-date performance is up approximately 15 to 20%. And when you think about IPOs as an asset class, IPOs, pricing to current on average is up about 20%. So when you think about generating returns, if you're a portfolio manager, you want to be investing in IPOs when they are performing in line or better than the market. And that's what we're starting to see with the IPOs right now. So that's generating growing demand and growing receptivity for the IPOs.
So you think that performance will be enough to sort of outweigh some of the volatility that we've seen and we'll see some more IPOs?
I do think so. The one other thing that's giving me increased confidence on a more robust, not vibrant IPO, but a growing IPO market is that in addition to the performance of, call it the NASDAQ and S&P, we've seen that performance in the broader markets broaden out from, the Magnificent Seven, the super large cap companies, out to the Russell 1000 and 2000. So investors are starting to broaden their portfolio out to the mid and small cap companies. And those companies are starting to perform well, which is a better corollary to the IPO market.
Right, because those are the size of the companies that we normally see go public.
Absolutely. That's right.
And of course, the U.S. elections are approaching. Do IPOs tend to slow around the time of elections?
It's interesting. We've looked very hard at this question because every presidential election cycle, there's always the worry and the concern about will the capital markets dislocate as we get closer to a presidential election. And we've looked at it several different ways, whether it's a Democrat in office, a Republican in office, whether it's a lame duck president, et cetera, et cetera. And we cannot find any correlation to a presidential election cycle and a slowdown or dislocation in the capital markets and in the IPO market itself. There's always a worry, and bankers and companies and investors alike track it very closely. But when we look at the data, there really is not a correlation, and there's usually not much of a slowdown during that presidential cycle.
That's interesting. So it's kind of more of a fun talking point than anything else.
Exactly. Always being asked the question. And when it comes to, the September, October, November timeframes, we generally don't see much of a difference in a presidential year versus a non-presidential year.
It sounds like from what I'm hearing from you is that we're seeing an improving IPO market. So what are some factors that companies might weigh when considering to go public now or maybe waiting until 2025?
I think it's a couple factors. One, companies will look at their own performance. Obviously, how is their growth currently and what's their outlook for the next several quarters and ideally, 1 to 2 years, which is hard to predict, but important to have a grasp on. With that overlay, they'll look at the current market environment. And then in addition, it always comes down to valuation expectations. I always look at, right now I'm thinking about the software industry. In 2000 and 2021, software IPOs were the most active space, and the valuations at which these companies were going public were in, sometimes the 20 and 30 times revenue multiples. Then when the bubble burst, so to speak, in 2022, those companies and many other software companies sold off dramatically, and they now trade at, call it, high single-digit revenue multiples, which, by the way, is still very healthy. So when you think about a software company that's evaluating the IPO market, they needed to continue to grow, change their business model to think about not only revenue growth, but earnings, and then reassess whether or not they want to be going public with a valuation that is depressed from 2020 and 2021, but by all measures, is still a healthy valuation, which would be in the oftentimes high single-digit revenue multiples.
So are those valuations, are they good enough for some of these PE-backed and VC-backed companies to go out and go public?
I think so. It becomes company specific, but the pipeline for PE and VC-backed companies is quite strong. A lot of these companies are of scale and continuing to grow and perform quite well. And we've started to see some of these companies tap the public markets. Most recently, there was one company, OneStream, which is a KKR-backed IPO that went public. And for full disclosure, Truist was a book runner on that transaction, and it did price and it has performed.
Yeah, I'm sure that's very welcome for the market to see some of those PE-backed companies come out.
Absolutely. And when you get some success on these transactions, it gives the investors and the companies waiting to go public increased confidence to do more deals.
What has issuance been like for other products, maybe convertibles or secondaries?
So that's a good question. The convertible and follow-on markets have been very strong. For example, the follow-on issuance is up about 40% year over year to date at about $90 billion of issuance. And the convertible issuance is up about 50% year over year at about $50 billion of issuance. And that's important as we think about the IPO market, because what we would traditionally see and we're seeing now is follow-on and convertible issuance will lead the way to a more healthy IPO market. So investors are investing in existing public companies when they want to issue more stock, and those deals are being successfully met by investor demand. And as that happens, and that continues to happen, then the more risky asset, which would be an IPO, will be more well received. We're still, I believe, in the beginning innings of the IPO market rebound, but it's definitely taking shape.
So those convertibles and follow-ons, sort of the investors dipping their toe in the water.
That's right. And how the performance of those deals pan out either gives increased confidence or gives investors pause. But right now, those deals are working fairly well. And so that gives the investors increased confidence to look at IPOs when they come to market.
And from an IPO standpoint, are there any sectors that stand to benefit more from the expected rate cuts that we're likely to see in September?
When we think about the rate cuts, I can't really point to a sector that's going to benefit more than others. I say that because as the rates are expected to be cut, we're seeing a couple things come into play. One, the cost of capital for the companies will go down. That will benefit all sectors, really, especially those that have higher debt loads than others. But really what's at play is where are investor dollars when moving to when rates are decreasing? And what we're already seeing is investors repositioning portfolios to move slightly some money out of fixed income investments and into equity investments as they chase and position for greater total returns in the future. So what that will do is create more dollars to be put to work in the equity market, which will benefit all companies that are looking to go public.
As investors have been moving those dollars over into equities, are there any particular sectors that have benefited more so far?
So far, no, but what I do expect is when I think about and look at the pipeline of companies that we're tracking, we expect that software and life sciences will continue to be the most active sectors in the IPO market. Those in any given year typically make up, greater than 50% of the IPO market. And we expect that to continue and maybe even accelerate into 2025 as the pipeline and the amount of sheer number of companies in those sectors that have been waiting for a more robust IPO market line up to go public. Will there be other sectors that benefit and have activity? Absolutely. We're seeing some consumer and retail. We're seeing some basic industrial companies and real estate companies also. So all sectors are eyeing the market actively. But at the end of the day, the real drivers of the IPO market will continue to be what has been historically the drivers, which is technology and life sciences.
And those sectors are historically the drivers. Is it just because of the returns, the potential returns that they offer?
The potential returns they offer, absolutely. And the sheer number of companies that are in the private space considering IPOs. For example, we're tracking at least 100 software companies that are of scale and have the fundamental dynamics that can be successful public companies. And there are at least that many, if not double, in the life sciences sector, particularly biotech. And when you look at the other sectors, there's just smaller number of private companies that are positioning themselves for a public IPO.
Makes sense. And just to sort of wrap up here, thinking about 2024, I mean, has it been on par with what you expected for the IPO market? And as we look forward to 2025, do you think 2025 will be better, worse, or more, or in line with 2024?
I think 2024 has developed, I'd say, in line with my expectation. So far, we've seen about $25 billion of IPO issuance. That's already more than all of last year, which was about 20 billion, but it's still far behind the years of 2020 and 2021. I mean, 2021, we had $150 billion of IPO issuance. So that was a record year. A steady state year, I would expect $50 billion of IPO issuance. So we're still a little bit behind that. I would expect us to finish in the, call it $35 to $40 billion this year. So we're still in the development and recover phase after 2 years of virtual nuclear winter in the IPO market. So this year has been a nice rebound and building the base for what I expect to be a very busy and very successful 2025.
So we're expecting to see more activity next year.
We are. We're very optimistic around both the pipeline, the market backdrop, and the quality of companies that are looking to go public in 2025.
Great. Okay, well, hopefully that comes to fruition.
Fingers crossed.
All right, Wes. Well, thanks a lot for your time today.
Thank you.